Hope you're all having an excellent week. Markets have been a little bit down this week, but we are still very optimistic about their ultimate path, even though there could be a little bit of weakness in the end of October. One of the reasons we think that is simply because of rates. Now, it's possible rates are simply going up because of positive economic data. It's also possible that there's a sort of the beginning of a Liz Truss-esque rebellion against the U.S. fiscal situation. And if that is the case, it could be problematic for markets. Now, we're not sure if that's the case. We think that economic fundamentals will ultimately carry us through. But because of the uncertainty, we gave you a VIX trade this week that did quite well. It actually popped 81% on the first day that we recommended it, because we recommended it right before a volatility spike. That's what we're kind of after at Punk Rock Traders is, I would also point out that you would have gotten a much better pull off of this trade than off of buying the short-term VIX ETF, right? So Punk Rock was part about do it yourself, and so was our trading. So I just wanted to share that victory with you. It's still up 26%, and it's going to be a good hedge in case there's any acute uncertainty or nastiness associated with the U.S. election. I want to talk about two stocks today, and they both start with a T: Taiwan Semiconductor and Tesla. Now, Tesla had a big earnings beat yesterday, and so you might be thinking, hey, I should buy some Tesla. We would advise against that, right? And we'll tell you why. Tesla is really a great stock for trading. It has some of the deepest options markets in the world. But if you're putting money to work for long-term ownership, which is something we don't always talk about at Punk Rock Traders, but I did want to talk about it because our strategy toward using options is very much different than most people. Most people treat an option as a sports bet and only use historical price data to inform their positioning, or the Black-Scholes model, right? While both those tools are very useful and we use them, we try to stick to options on companies we like fundamentally, right? And I will say this, the most important ratio for any company, right, is the return on invested capital minus the weighted average cost of capital. This is the best proxy for whether management is delivering value to shareholders or not, right? Now, companies, just like people, they have a life cycle. And, stock price can tell you where they're at in their life cycle, right? A lot of things about a company can tell you where they're at in their life cycle. Their margins compared to peers. And, the higher the margins and the higher the ROIC minus WACC spread, the more shareholder value is being created. And I would also argue that the higher the ROIC minus WACC spread, although it does tend to normalize over time, the higher the spread, the more endurable the moat of the company is, right? And that's a defensible competitive advantage that will continue allowing the company to create value throughout time, right? Now, we have to remember with intrinsic valuation, a lot of times the lion's share of value is in the terminal value, right? The terminal value can make up to 70 or 80% of the total value of a stock. And what the terminal value is the point of which we're no longer measuring actual growth rates, right? We pick a terminal growth rate that we think the company can sustain after either 5 or 10 years. Now, when you're getting up to high PE ratios, like for TSM and Tesla, the question about long-term valuation is which company has a better chance of sustainably delivering value, right? And I would say there has been two catalysts in the past 24 hours, and I want to use this opportunity to think about them differently, right, than you would normally think about fundamental catalysts. Tesla smashed earnings. They beat EPS expectations by quite a bit, but a little fly in the ointment, they did not beat revenue expectations. They came in short. Now, Taiwan Semiconductor did no such thing, right? Taiwan Semiconductor's revenue is growing. Their earnings are growing. and their margins are massive compared to the competition. So what does this say? This says that they're earlier in their value creation cycle and maybe have a more defensible competitive advantage than Tesla. When you compare Tesla to peers, it looks pretty similar. When you compare TSM to peers, it looks like they're in different industries. So I want to first bring up the fact that TSM was our trade of the week on 9/19. We do have to do a little victory lap here. Its best performance is at 210%. We think it'll eventually exceed that in this holiday buying season that's coming up. But it got a nice little candle up today, as you can see. And, I do want to talk about the fundamentals because most options traders do not care about fundamentals. We do. Because if you're betting on a company that is earlier in their value creation cycle, they have a higher chance of outperforming earnings expectations. It can give you an edge, but you do have to understand where the real value for shareholders is, and that is in ROIC minus WACC. Real quick, I had our Punk Rock Technicals master, Ben Turkin, and that's at Ben Turkin, Turcan. And he's saying that there's, some very positive technical trends for TSM in place, and that, that it could retrace, but if it does, it's going to be relatively short-lived. So that's good news. I want to just go over TSM's earnings because they were spectacular, right? And you can see here, the margins are very high for this company. They have a high cost of sales because semiconductor production is very capital intensive. But when you compare their margins to peers, it doesn't even look like their peers are in the same industry. And this is why TSM has a much more endurable competitive mode than Tesla. Look at Intel compared to TSM. This is what happens when a company falls behind on competitiveness. TSM is ahead on competitiveness, and it would be very hard for Intel to catch up with it. Look at the difference of their earnings. By the way, this is App Economy Insights. Great tool for visualizing earnings. I love it. It saves me a lot of time. You can also see in the price performance, right? There's only 3 major companies who can produce fabs at scale at the leading edge. They are TSM, Intel, and Samsung. As you can see, TSM is breaking away from the pack, right? We want to listen to Professor Price. We don't want to lecture Professor Price. As you can see, right? All companies will eventually lose their edge. The question is how long can you defend your competitive edge and how enduring can you make it, right? Tesla is a car company. That's a capital intensive business with fickle consumers and a lot of problems, right? You did have some very good guidance on margins. So, maybe they're getting a new lease of life on their car business. But here's the thing. I don't want to own it and wait to find out, right? Their margins have been problematic. TSM's margins have been just wowing people quarter after quarter, right? So in my opinion, TSM is closer to the growth life cycle stage, and Tesla's auto business is near the maturity stage. Now, the reason Tesla is able to have such a high valuation and such enthusiasm is because people have faith in the founder's ability to use shareholder capital to deliver new sources of cash flow other than the auto business, right? Again, that's a wait and see thing. The proof is in the pudding there. And Elon Musk does have a very admirable history of being a good steward of shareholder capital. He does. But everybody gets old. Everybody loses their edge. An auto company life cycle is very fickle, right? Like the advantages he showed as a founder in the early stages of the company, they may be not the same skills required to run a mature auto company. So I think there's also some founder risk if he takes a potential appointment in the Trump administration. So these are all things hanging over the Tesla stock, despite the recent enthusiasm for earnings yesterday. And the auto business is maturing, just like the Tesla bodies are maturing, right? They don't look new anymore. We'll see what the robo-taxi can produce, but there's a lot of regulatory question marks and other question marks there too. So with TSM, they're just dominating their peers, right? They're exceeding expectations. They're naming prices. and their clientele are the richest, most financially resilient companies in the history of the planet, right? Tesla is exposed to the US consumer, and they've been resilient for a while, but eventually that consumer is going to show some weakness, and Tesla will too. You can see Tesla's net profit margin is much lower than TSM's, and these are both capital-intensive industries, right? TSM has invested in intangible capital in a way that the peers cannot keep up with, right? And there was a big piece of news today that I think is even bigger for TSM than their earnings report. That piece of news is that their new semiconductor production fab in Arizona is capable of producing a quality of chips which yields 4% more than the facilities in Taiwan. Now, this is a major development for Taiwan Semiconductor's value creation, because one of their main risks has to do with the geopolitical risk of China trying to reunify the island by force, right? That could really stand the technological revolution still if that were to happen. And now that TSMC has proven that they can produce outside of the country with different labor laws and everything at a similar or even superior yield, that is a major, major plus for TSM's ability to create value long term, right? Tesla has a lot of hope. There's a lot of hopeful projects that could create value creation long term, but they're also facing a lot of competition in those areas, right? Artificial intelligence is facing a lot of competition from a lot of very capable competitors. So, and here's another thing I will show you, right? Let's look at Tesla's earnings. Let's look at them compared to GM. They look very similar. The profit margins are very similar, right? This means that Tesla, in my opinion, has lost some of its competitive edge, right? And you can see that the EV space is saturated with competition. And the fact that Tesla looks like an auto company means it is an auto company. And if you want to bet on Elon Musk, by all means you can, and it might be a good bet. But what I'm saying here is that given the current state of the company's financials, it's better to own TSM. You can also see in the price performance, right? When you compare Tesla to peers, its price performance has been similar to them over the last year, despite the massive earnings beat yesterday. That's a signal that the competitive playing field is leveling. Because if you looked at this a couple years ago, you would have had to take Tesla off the graph to even see these other auto companies. Again, what is the main justification for owning TSM over Tesla? The main justification here is very simple, okay? TSM is creating more shareholder value than Tesla is. And in my opinion, based on the analysis we've been over in this video, I think TSM has a higher likelihood of continuing to produce value at a higher ROIC minus WACC spread than Tesla, right? So Tesla's spread is, it's about 4%. TSM's much, much higher by factors, right? It's over 14%. So it's higher by Tesla than a factor of more than 3. And that's why you want to own TSM and you want to fade the recent Tesla rally. In terms of ownership, right? Trading options on Tesla, well, we're going to do some of that, so don't worry. But in terms of ownership, I prefer TSM to Tesla.